Welcome back to Investing Talk podcast. The immediate question we're tackling today, it's one that's definitely been making waves. Is Plus Therapeutics a good buy right now?
Yeah, it's popped up a lot lately.
Exactly. This company, they're focused on these highly specialized cancer therapies. We've seen some incredible volatility, but our sources are pointing to potentially huge upside.
Which makes right now a pretty critical moment for the stock, doesn't it?
It really does. So before we get into the weeds, just a reminder, if you find this helpful, please hit subscribe, like the video, maybe leave a comment below.
And definitely let us know if there's a specific company you want us to look into next time. Just drop it in the comments.
Great point. Okay, so what's our goal today?
Well, our mission really is to analyze the source material we have on Plus Therapeutics. We'll look at the fundamentals, the technical momentum, and critically, those near-term catalysts.
Right.
The aim is to give you the clearest picture possible, balancing the high risks with what could be immense rewards.
Okay, let's jump right in then. Let's unpack this. What exactly does Plus Therapeutics do?
Okay.
They're not just general oncology, are they? The sources highlight this real niche focus: central nervous system cancers, aggressive solid tumors.
Exactly. That's the key. They're targeting areas like CNS cancers, think glioblastoma, and these aggressive solid tumors. It positions them right in that orphan drug space, underserved indications.
And why is that specific focus so important? Why does that matter for, say, their valuation potential?
Well, that specialization, it's really their whole strategy. CNS cancers, like you mentioned, glioblastoma or leptomeningeal metastases, they're incredibly hard to treat.
It's the blood-brain barrier.
Precisely. It shields the tumor.
Okay.
So because there's so few effective treatments, any therapy that actually works, it gets noticed fast.
Okay.
It minimizes competition, potentially maximizes pricing power. I mean, that's the financial upside of tackling the really tough diseases.
Gotcha. And the way they're tackling it is pretty unique, too. This lead candidate, REYOBQ. Can you walk us through the tech? Because the sources use this jargon, rhenium-188 nanoliposome therapies. It's a mouthful.
It is a bit dense, yeah.
What are they actually injecting? What makes it special?
Okay, so think of it as targeted miniature radiotherapy delivery. REIOBQ is a patented radiotherapeutic.
Okay.
So instead of flooding the whole body with systemic chemo, this rhenium-188 nanoliposome platform takes rhenium-188, that's a short-range radioactive isotope, and wraps it in these tiny protective fat bubbles. Those are the nanoliposomes.
Little delivery packager.
Exactly. And these are injected directly into the tumor site or sometimes into the fluid around the brain and spinal cord.
Ah, okay.
And because of their size and how they're formulated, the drug stays concentrated right where it needs to be. You get maximum radiation dose on the cancer cells, minimum toxicity elsewhere in the body.
So it's that combo, the delivery system and the isotope, that gives them their edge, their IP moat.
That's it. The proprietary delivery plus the isotope creates that durable intellectual property protection. And it's likely why the FDA has already granted them fast-track designations. They see the potential.
Okay, that makes the tech much clearer. Thanks. Now let's pivot to the financials, because the story here gets a bit complex based on the sources. Operationally, looking back at 2024, revenue hit $5.82 million. That's up 18.5% from 2023, so activity is definitely accelerating.
Yes, that accelerating revenue is a positive sign. Their first commercial product, CNSide, that's contributing there, and that revenue helps fund the REYOBQ pipeline, which is key.
Right.
And on the expense side, the net loss actually narrowed a bit by about 2.5% in 2024, down to negative $12.98 million.
Which suggests some cost control.
It does suggest they're being mindful of costs, which is, absolutely vital for a biotech that isn't profitable yet from its main drug candidates. Their market cap is around $83.3 million, and they have no significant long-term debt. Typical for this stage, really, funding through equity.
Okay, but here's where it gets maybe a little tricky, or at least needs clarification. The sources highlight this big recent win. Q2 2025 results showed a net income of $5.2 million for that quarter.
Right, a reversal from the loss.
Exactly, a big reversal. You mentioned cost control, but one source attributes this swing mainly to favorable derivative changes. So how disciplined is the cost control really if the operational loss is still there and the headline profit is, well, maybe accounting noise?
That's a really critical distinction. You're right to point it out. When we talk about disciplined cost control, we're usually looking at the underlying operational expenses. The cash burn for R&D, for G&A.
Okay.
That $12.98 million annual loss figure, That's probably a better indicator of the actual operational burn rate.
So the $5.2 million profit?
That Q2 net income is indeed largely non-operational. Those favorable derivative changes. That typically refers to how certain financial instruments on the balance sheet, like warrants maybe, are valued at a point in time.
Mark-to-market accounting.
Exactly, mark to market. If the stock price goes up, sometimes the liability value of these things can go down on paper, creating a non-cash accounting gain. Looks good on the headline P&L, but it's not cash from selling products.
So investors need to kind of strip that out?
Absolutely.
Yeah.
You need to look past those derivative gains to see the true cash burn. And that burn rate still suggests they'll likely need more capital down the road.
Okay, that adds important context to the whole commercial strengthening idea, but they did make a genuinely significant commercial move, didn't they? Securing that national coverage agreement with United Healthcare for the C-Inside test.
Yes, that is significant.
Why is coverage for a diagnostic test like this such a big deal commercially?
Well, C-Inside is this advanced test, right? It detects tumor cells in cerebrospinal fluid. For CNS cancers, spotting tumor spread early and accurately, especially into that fluid around the brain and spine, is vital for deciding on treatment.
Makes sense.
Getting coverage with a giant like United Healthcare, that potentially opens the door to over 51 million insured Americans. It shifts CNSide from being maybe a niche test people paid for out of pocket to something that can be routinely reimbursed.
Which should dramatically boost its use.
Exactly. Boost utilization and, crucially, provide a stream of consistent, non-dilutive revenue. And that revenue can directly help fuel the much more expensive ReWayOBQ clinical program.
And speaking of non-dilutive funding, they also got that $1.6 million grant payment from CPRI, the Texas Cancer Institute.
Right, CPRIT. And non-dilutive cash is always good news. It's external validation of the science, essentially. Someone else believes it's worth funding.
Okay, let's move on to what feels like the most exciting part of the source material. The clinical momentum. What's the headline data driving all this analyst excitement and those, frankly, huge valuation targets?
Yeah, the data, particularly for ReWayOBQ and leptomeningeal metastases, or LM, that's really the core of the excitement right now.
And LM is?
It's a truly devastating complication. Cancer cells spread into the cerebrospinal fluid. The prognosis is usually measured in just months. Standard care is often chemo, but the outcomes are generally very poor.
Grim.
Very. So the new trial results for ReWayOBQ in this setting showed a 76% radiographic response rate. That means the tumors shrank, or at least stabilized in 3/4 of the patients.
Wow, okay.
And an even higher clinical response rate, 87%.
Oof.
But the really potentially revolutionary finding, the median survival for these patients more than doubled compared to standard care benchmarks.
Doubled when standard survival is just months.
Exactly. When standard is maybe 4 to 6 months, doubling that time, that's a profound improvement for patients with virtually no other good options. That's what gets people talking about disruptive potential.
Yeah, you can see why that kind of clinical success would ignite investor enthusiasm. Okay, let's connect that to the charts. How is the market reacting? What's the technical picture telling us?
Well, we've definitely seen a breakout. The stock chart shows this consistent pattern, higher lows and higher highs, just over the past quarter.
Which suggests...
It suggests it's not just, random retail buying. It often indicates that larger investors, maybe institutions, are starting to build positions. They're recognizing that potential inflection point driven by the clinical data.
And the technical picture itself looks pretty robust, according to the sources, trading above all the major moving averages, 10, 20, 50, 100, and 200-day.
Which is about the strongest bullish confirmation you can get from moving averages, yeah.
But we have to temper that with the volatility you mentioned right at the start.
Okay.
The 52-week range is huge, from about 16 cents up to $2.31.
Underscores the risk.
It really does. So while the sources suggest a likely bullish trading range for the next 3 months between, say, $1.72 and $1.10, this is clearly not a stock for the faint of heart.
Not at all. And the analyst's conviction reflects that leverage potential both ways. The consensus is a strong buy from the 4 analysts covering it.
With recent upgrades.
Yeah, 2 upgrades just in the last 90 days, likely right after that clinical data came out. And the average 12-month price target is, well, pretty aggressive at $8.
$8 from under $1 now. That implies what, over 850% upside?
It does. It's huge.
That sounds incredibly speculative. What's the justification? How do analysts get to an $8 target? It can't be based on current earnings.
No, definitely not. The rationale isn't based on current revenue at all. It's based on projections of peak sales if ReWayOBQ gets approved in just 1 or 2 of those key underserved markets, specifically glioblastoma, or LM.
Ah, okay.
Given the lack of competition and the superior efficacy suggested by the trial data so far, they're essentially modeling a scenario where this therapy captures a really significant slice of what could be a multi-billion-dollar market.
So it's a discounted cash flow based on future success?
Pretty much. Discounted cash flow assuming successful phase 3 trials and approval, not based on the things stand today. But we absolutely have to mention the outliers too. The high target out there is $21, and there are some, frankly, extreme speculative forecasts floating around, some even above $100 for 2025.
Wow. Okay, caution definitely needed there.
Extreme caution. Those kinds of targets assume basically everything goes perfectly. Every trial succeeds, maybe even an acquisition happens at a massive premium. Highly speculative.
Understood. Okay, shifting gears slightly to market sentiment. Retail forums, unsurprisingly, seem pretty bullish. They're citing the pipeline, the low float.
Standard retail chatter for these kinds of stocks.
Yeah. And there are the usual unconfirmed rumors floating around, too. Potential new trial results coming soon, maybe partnership talks with bigger oncology players.
Which brings us neatly to the really high-stakes catalyst coming up. Because this raises the crucial question. How do these short-term, very real risks stack up against that huge but potential $8 target?
And the fourth quarter looks pivotal.
It really does.
We've got the Q3 2025 earnings release coming up. Sources seem a bit confused on the date, October 31st or maybe November 13th.
Either way, late October, November. And that release will be key for updates on financials, sure, but more importantly, on the progress of those ongoing clinical trials.
But there's something even more immediate, isn't there? Something potentially more dangerous for the stock price in the very near term.
Yes. The big one is that regulatory deadline, November 12th, 2025.
The Nasdaq compliance deadline.
Exactly. That's the deadline to get the stock price back above $1 per share and keep it there to maintain their Nasdaq listing.
And failure means?
Failure could lead to delisting, which is, pretty disastrous for liquidity, for institutional ownership. It makes the stock much harder to trade.
How big of a threat is this really, especially with the stock trading kind of near that level anyway?
It's a very serious, very binary risk. If the positive momentum from data or news can't lift the stock above $1 organically and keep it there,
then what?
Then management would likely feel forced to do a reverse stock split right before the deadline.
Which technically fixes the compliance issue.
Technically, yes. But reverse splits often put downward pressure on the stock price afterward. Investors tend to see them as a sign of weakness, even if the underlying science is sound. You have to assume management is laser-focused on navigating this, maybe timing announcements strategically around that date.
So a lot riding on that November 12th deadline. Beyond that hurdle, though, we do have those highly anticipated clinical trial readouts.
Right, for RAOBQ and glioblastoma and also in pediatric CNS cancers. Positive results there could potentially make the $1 compliance issue disappear overnight.
And looking further out, longer term.
Longer term, the speculative upside includes those things people always hope for with promising biotechs, potential partnerships, maybe even M&A with a big pharma company looking to bolster its oncology pipeline.
Breakthrough therapy status could also be on the table.
Given the strong efficacy data in LM, yes, it's possible they could apply for breakthrough therapy designation. That would potentially accelerate the whole review and approval process significantly. And then, of course, eventually global expansion, Europe, Japan.
Okay, but let's bring it back to the risks. Connecting this all together, we have to acknowledge they are substantial and immediate.
Absolutely. First and foremost, as a clinical stage company, plus Therapeutics faces huge binary trial risk. Meaning the whole investment thesis, that $8 target, it really hinges on the upcoming data for glioblastoma and pediatric cancers mirroring the success they saw in LM.
And if it doesn't?
A trial failure, or even just a significant regulatory delay. That could instantly erase that 850% upside potential and lead to, frankly, catastrophic downside for the stock.
Then there's the compliance risk we just discussed, that looming November 12th Nasdaq deadline.
Right. Even with amazing science, getting delisted damages credibility, hurts liquidity. It's a major overhang until resolved.
And finally, the classic biotech problem, dilution risk.
Yep. They're funding operations mainly through equity offerings right now. While the CPRET money helps and the CNside revenue is growing, those big, expensive phase 3 trials cost a fortune.
So they'll likely need to raise more money.
Almost certainly. Future equity offerings are a standard risk. They raise cash for the company, but they dilute existing shareholders, which can dampen the share price appreciation even if the company hits its milestones.
Okay, so pulling all this together, what does it mean for you, the listener? Based on everything in the source material, this looks like a classic high-risk, high-reward biotech play.
Definitely skewed towards high risk, high reward.
Yeah. It seems supported by improving fundamentals, that steady revenue growth from C inside, some cost control, even with the derivative caveat, and definitely strong technical momentum recently, confirmed by those moving averages.
Our overall analysis, weighing all that, comes out with a bullish rating of 8.5 out of 10. That reflects the sheer magnitude of the potential reward if things go right.
So the investment horizon here seems kind of dual, doesn't it? Either you're looking at it as a short-term trade, maybe playing the upcoming earnings or those clinical readouts.
Right, trying to capture volatility around news events.
Or it's a much longer-term hold, a venture capital style bet, really, positioning for potentially massive wealth creation if ROIOBQ genuinely becomes a disruptive therapy.
And the clinical data, especially in LM, certainly suggests it could be a transformative therapy. CNS cancers. The options there are just so limited, so scarce.
Doubling median survival is hard to ignore.
It really is. So, considering those incredibly strong clinical responses we've seen so far, here's the final thought. How much weight should you, as an investor, really place on that short-term, tactical $1 Nasdaq compliance hurdle versus the much bigger long-term potential for something like a breakthrough therapy designation, market exclusivity, and fundamentally changing outcomes in a desperately underserved market? It's a tough balance.
A very interesting question to ponder. Thank you for joining us on Investing Talk podcast.
Thanks for listening.
We'll see you next time.